I think it's clear we're living in an inflationary environment, and all the currencies in the world are at best pegged to the dollar, and at worst they're weakening faster than the dollar. So traditionally, the Treasury reserve asset of corporations everywhere in the world is either cash or a cash derivative like sovereign debt. And if we take the example in the United States, a company like MicroStrategy would have, if we had $500 million in the Treasury, we would have $500 million of Treasury bills yielding 3% or 2% interest. Why would a company want to own Bitcoin in its treasury? Well, I'll take two cases. One is if you're a Western company, and the second case is if you're in the developing world, like in South America or Africa. So in a Western country, you have a treasury asset which is yielding 3%, but the rate of expansion of the money supply is anywhere from 7 to 10% a year for the past 90 years. We calculate the rate of expansion of the US dollar for the last 90 years is about 7% a year. And so against scarce desirable assets, you're losing half of your treasury every 10 years under the best of circumstances, assuming that there's a spread of 5–6%. And so in the US, under normal times, the reason you would own Bitcoin is because you have a chance of appreciating the asset value of your balance sheet. And in difficult times, like over the past 2 or 3 years, the money supply has been expanding about 14 to 20% a year. And in that case, you would do it because you've got a negative real yield of minus 15% in the Western world. So on $1 billion, it costs you $150 million in purchasing power to use Treasury bills as a Treasury asset. In the rest of the world, it's a little bit simpler calculus. Like if you're in Argentina or Venezuela or Bolivia, if you have Treasury assets in the local currency, you've got an inflation rate that's effectively 40 to 100% a year, you literally can't have a treasury. Whatever money you have in a treasury of your corporation in a weak currency like that is going to zero within the decade, and maybe it's going to zero within 36 months. So in their case, they then have to figure out, how do I swap out of a weak local currency to something stronger? The conventional view would be switch from the local currency to the dollar. And the problem with that is you can't buy dollars without going through the conventional banking system. So if you ended up with $1 billion of pesos and you converted it to $1 billion in dollars and you had it in a local bank in Lebanon, what happens is the Lebanese banking system sells $100 billion worth of dollars, but only has $10 billion in custody. And so when people try to redeem their dollars, the bank fails. FTX failed by not having assets, but Silicon Valley Bank failed, and First Republic Bank failed for the same reason. So if you end up holding dollars in a fractional reserve bank, and they're all fractional reserve banks, then when there's a run on the bank, you lose your treasury assets and you're bankrupt. So the reason you would want Bitcoin if you lived anywhere outside the US is because your currency is going to zero and the banking system is not trustworthy, and the odds that it's going to default on you are sort of 1 in 10. In Russia, the entire banking system failed in, I guess, 98 or so. And about every 20 years in a lot of countries, the entire banking system collapses. When the banking system collapses, the playbook is your local currency is devalued, then your foreign currency reserves, like the dollars or the euros, get converted to local currency, and then they get devalued and frozen. And so you really can't have a treasury. So you end up basically starting from scratch every single year. In the US, we haven't seen large corporations lose their deposits in dollars or in treasuries in recent memory. But what they are losing is anywhere from 5 to 10% of their treasury value every year for the past 100 years. So that's the reason to use Bitcoin as a treasury reserve asset.